In Hong Kong, a name once synonymous with wealth is now teetering on the edge. New World Development has delayed a $77.2 million interest payment on 4 perpetual bonds, shaking investor confidence overnight. Their 4.8% bond price collapsed from 25.4 cents on the dollar to just 19.09 cents, while their stock plunged 7.5% in a single trading session. But this isn't just about one company. It's a warning shot across China's entire real estate sector, an industry once propping up the dreams of a billion people. And now, it's crumbling. For years, New World Development was a symbol of financial strength. But beneath the shimmering skyscrapers, debt was quietly piling up. By the end of 2024, the company's net debt reached 165 billion Hong Kong dollars, with a staggering debt-to-equity ratio of 91%. Unable to withstand the pressure, the company made a desperate move, suspending its bond payments. Investors were rattled. Bondholders faced a harsh truth: what was once deemed safe had become a liability. And the ripple effect was immediate. Real estate, which once underpinned China's explosive growth, showed deep cracks. Developers dependent on easy credit suddenly found themselves on the wrong side of a tightening financial noose. It wasn't just about delayed payments. It was about a paradigm shift. The collapse of one giant signaled that even the most prestigious players were no longer immune to the growing rot inside China's economy. Meanwhile, households who had poured life savings into property found their nest eggs shrinking fast. The dream of security was eroding, and it was only the beginning. As the crisis deepened, the fallout spread beyond New World. Dalian Wanda Group, once China's largest commercial property owner, rushed to sell 48 Wanda Plaza shopping centers. The fire sale, valued at 50 billion yuan, or about $7 billion, was a steep discount compared to previous valuations, down more than 30%. But selling was no longer optional. Wanda had already offloaded over $30 billion in assets since 2016, desperately trying to stay afloat. Now, it was cashing out its last crown jewels. Investors who once saw Chinese property as a gold mine were backing away. Banks, heavily exposed to real estate loans, tightened credit lines. Small and medium-sized developers, without the cash reserves of giants like Wanda or New World, began to topple like dominoes. In Beijing, Guangzhou, and Shenzhen, rows of gleaming new apartments sat empty. The once frenzied housing market slowed to a crawl. Home prices in key cities dropped by double digits while vacancy rates soared. But the real damage was psychological. The unwritten social contract that buying property was the surest path to wealth had been shattered. Now, even newly finished developments were being sold at auction for a fraction of their original price. The ground was no longer solid. China's middle class, the very engine of its growth, found itself standing on quicksand. While the headlines focused on corporations, the real heartbreak unfolded in ordinary households. In cities once hailed as real estate havens, Shanghai, Beijing, Guangzhou, families found themselves trapped. Mortgages taken out during boom years now hung like a millstone. Properties lost 20%, 30%, even 40% of their value. Yet the debts remained. Many homeowners, faced with negative equity, simply walked away. Meanwhile, younger generations were retreating. Surveys showed that 61% of China's Gen Z had no intention of ever purchasing a home, a seismic shift in attitudes that once considered property ownership a rite of passage. The broader impact was brutal. Construction slowed. Furniture retailers shuttered stores. Bank loan defaults surged. Even government stimulus measures, lowering mortgage rates to historic lows, failed to revive the market. Buyers were no longer just cautious, they were absent. In many neighborhoods, unfinished towers stood like modern ruins. Street after street, lights stayed off, windows remained empty. What was once a symbol of prosperity now became a ghostly monument to broken promises. For millions, home ownership had turned into a slow, inescapable financial trap. And the middle class, once the envy of the world, was quietly bleeding out.
Then came the final blow. In a market already gasping for air, distressed properties flooded auction houses. Judicial auctions in China's major cities hit record levels, with default rates skyrocketing. Over 57% of real estate auctions failed to attract a single bid, leaving banks and local governments saddled with properties they couldn't sell. Homeowners who clung to their investments watched helplessly as prices spiraled downward. Young couples delayed marriage and childbirth, citing financial insecurity. Elderly parents who once believed a home was the greatest gift to pass down now found that gift to be a burden. The psychological contract that linked housing to security had ruptured. The psychological contract that linked housing to security had ruptured. The dream was broken, not with a bang, but with a slow, grinding collapse. And the repercussions were not just financial, they were societal. A generation raised to believe in the promise of homeownership was losing faith, not only in real estate, but in the very system that had encouraged it. What was once a cornerstone of Chinese economic policy was now crumbling, piece by piece. Behind the headlines and statistics lies a deeper story, one that few dared to acknowledge. For decades, China's economic miracle was built on a simple promise: invest in real estate and your future would be secure. Today, over 70% of Chinese household wealth is tied up in property assets, far higher than in the United States or Europe. This wasn't accidental, it was by design. Local governments fueled the boom, selling land to developers to fund their budgets. Banks extended easy credit, pushing homeownership as a patriotic duty. For years, it worked. Families saw home prices soar, wealth accumulated on paper, and cities expanded at breakneck speed. But like all bubbles, it was built on trust. Trust that prices would always rise. When the slowdown began, that trust evaporated. The government's attempts to stabilize the market, lowering interest rates, easing mortgage restrictions, only masked deeper issues. Developers were over-leveraged, households were overexposed, local governments were over-dependent. Now, as property values tumble, that intricate web is unraveling. A financial crisis in real estate doesn't just threaten individual investors. It undermines the very foundation of China's growth model. And unlike previous downturns, there's no easy bailout. The tools that once reignited the economy, massive infrastructure spending, cheap loans, are no longer effective. This isn't just a market correction. It's a fundamental breakdown of a decades-old system. And the repercussions will not be contained within China's borders. If a house is no longer a symbol of stability, what remains? In a society where home ownership was once the ultimate marker of success, the collapse of that dream sends shockwaves far beyond economics. It erodes trust. It sows doubt. It forces an entire generation to reconsider what security really means. And as China grapples with this unraveling, the world is left to wonder. Can a nation built on concrete dreams survive when those very foundations begin to crumble? Or is this just the beginning of a deeper, more irreversible decline?